There we go. Okay, I've just started the recording and let everybody know that this is live. But of course, if you're watching a recording, you know you're watching a recording, right? Okay, so it's about 4 minutes past the hour. It's what is today? December 29th. Got 2 more days left in the year, and just a bit past noon, and we're having folks settle in, and lots of good folks are letting me know that they can hear my voice. So great. Okay. Pardon me. Hang on just a second. All right. Sorry, I don't have my cough button set up here, so you had to hear that. I apologize. Okay, so folks, I have a confession to make, and the confession is that I haven't spent a lot of time with my preview program. Okay, my preview. The preview was going to show 2 out of 7 steps. And what I have done is I've put together my 7 steps, which I'll be sharing tomorrow night. We'll have a much more professional presentation, but it's only open to members of, folks that own the blueprint. And I'd like to convince you to pick up the blueprint if you haven't already. But point is, I've got all 7 points in my talk here today, and so what I'll do is I'll just kind of gloss over all 7. How about that? So you came for 2, you're going to get all 7, but I'm not going to spend as much time with the 5 that I'll spend greater detail and time in later on. What I am going to do is emphasize the 2. Does that make sense? Okay, we got a couple folks saying yes. All right, very nice. Okay, so let's get started. Okay, here's how to make 2016 your best year trading ever. The first thing to do is to make a decision. All right. I like to look at the Latin. I think it's Latin. Maybe it's Greek. I don't know. I think it's Latin. The Latin root of this word decision, D-E, means away from. And CIS is an interesting little fragment of a word. CIS means to cut. That's why scissors is spelt with a C where it doesn't seem to belong, right? The word incisor comes from this, CIS. What else? Make an incision, right? We're making a what? A cut. Okay, so what is a decision? A decision is to cut away. That's what DE means, away. CIS, cut. Make a decision. Cut away from any other possibility. That's what we're going to do. Number 1 is make a decision. And we want to support your decision with commitments. All right, we want to make 2016 our best year ever. So one thing I would do is I would add some funds to the trading account. Now, I don't say that you should take out a mortgage to add funds to your trading account. I don't say that you should necessarily borrow money or take money away from expenses that are legitimate expenses and put that into your trading account. That is irresponsible. I would never ever recommend that course of action. I would say, hey, sell off some stuff you don't need. You know, if you're not using that boat, or if you're not, if you're tired of your comic book collection or whatever, you could sell it, right, and add some funds to your trading account. But whatever we do put in our trading account, we want to protect that jealously, and we're going to talk more about that later. All right, you'll need to plan for your taxes and commissions. I do recommend for some folks that are still in their working years. Okay, I counsel a lot of folks that are beyond that. A lot of folks that are in retirement, or some folks even that are managing 7- and 8-figure accounts. All right, but for those of you that are still socking it away, I'm going to recommend that you get a second source of income. Perhaps a little side business, something that you can do to generate a little bit of money on the side. And let's think about this. Let's do the math, okay? It's recommended that you save 10% of your primary income, right? And put that away. And of course, where we would put that away, part of it anyway, we would put into our trading account, okay? But what if you had a side income? And it's not even big, you know, it's only 1/10 of what you make at your regular job or in your other business, but you dedicate all of the earnings of it to savings. Well, then 10% of 100% is still 10%. You'd still be saving the same amount of money, right? Or if you are continuing to use the discipline of saving 10% of your income, and then you also get this little side business going on, you would be doubling your savings by adding the second income. And this is sort of important, and I'm going to go into greater detail with that tomorrow night, some plans for that. Here's the second point. Keep it simple, all right? We need to have a written plan for our trading, a written plan, and a written journal also. And we want to know what we plan to do when we come to a decision. When you come to a decision point, you refer to your plan. You say, "Oh yeah, this is what we do." And so that's for planning for the future. But the written journal is also a record, so that you can look back and you can say, "Well, that was a bad idea," or you can say, "That turned out not as well as I had hoped, but it was the right decision at that time." Or you can say, what, that was good decision and good timing. And what we can begin to do is whittle away the unnecessaries, whittle away the things that detract from our trading, and emphasize the things that are working. Okay. The most important part of your plan, again, we'll go into greater detail, is to state what your tolerable losses are and stay with that. Okay. When you reach the level of, okay, this is how much losses I'm willing to accept, then you don't come to it and then make a new decision. We've got to stick with this. You draw a line in the sand, you don't cross over, all right? And something that I use my power options account for is whenever I'm making any kind of a trade, I will look at all of the ramifications of it and ask myself this question: what if the worst possible thing that could happen did happen? Would I still be okay? All right. I do this just before putting together an income method. We'll talk about that later. I'll do that just before putting together a trade, and ask myself, look, if the worst possible thing happens, and I'll have a visual with the power options tools. Okay. All right. Now, the first most important is to state your tolerable losses. The second most important is to let your winners run. And it's been said, Jesse Livermore, the fellow that made money at the top of the crash in October 1929, all right, Jesse Livermore made $100 million on that crash, back when $100 million was a lot of money. Chuckle, chuckle. All right. Jesse is known for saying, I make the most money when I sit. I make the most money when I sit. Okay, so we're going to talk about, tomorrow night we'll be talking about reviewing our plan. But here's a 0.3 out of 7. We want to control our losses, and here's where I'm going to spend a little bit more time. Okay, I'm going to spend a little bit of time on this one. So this is one of the 2 that we're going to spend time on, 2 of the 7. All right. So let's define a trading system. What is a trading system? Okay. First of all, I should mention that radioactive trading is not a trading system. I'm not going to be selling you a trading system. I'm not going to be teaching you a trading system when you pick up the blueprint. If you already own the blueprint, you probably know it's not a trading system. A trading system is rules for what you're going to trade. Okay, for example, what kinds of stocks, or if you're doing currencies or doing commodities, it's rules for what you will trade. Rules for entry, and those rules for entry might be fundamental rules. Hey, if the stock falls below this price is what I think it's really worth, right? Or it may be technical rules. It may be, hey, the chart pattern looks like a cup and a handle and a dog with a lollipop, or whatever the the witchcraft it is that you use, for technical entries. Okay, those are the entry rules, and then exit rules, and then your position size. This is what defines a trading system. Okay, a lot of folks trade without a system. They just trade by their feelings. But folks that are more successful trade with a system. All right, and what is left out very often out of a trading system is position sizing. So we're going to talk about that. Position sizing is actually the most important but most neglected, and it is something that radioactive trading can help you with. We can help you with the position sizing portion of your trading algorithm. Okay, I'm going to tell you a story. This is a true story. about 40 PhDs. Now, for the record, I'll state that none of these PhDs had their doctorate in statistics or probability analysis, all right? But they were some very bright people. These 40 PhDs were under the guidance of legendary trading coach named Ralph Vince. And Ralph Vince gave them each $1,000 of virtual money in a game, okay, in a trading game, 1,000 virtual dollars, okay, with a 60% chance of being correct. Okay, and what it was 100 trials, 100 bets that you could make, for example, with a 60% chance of being correct. So if you go 100 times, chances are you would be right 60 out of the 100 times. Okay, and even money payout. So if you bet $1, if you're right, you win back $1. All right, and if you bet $1 and you're wrong, you lose $1. All right, so you can see that over time this system should make money. Okay, it's a very winnable game, but there's more to this than just the odds. There's more to this than just the odds. All right, we're going to see why. 38 of these 40 PhDs lost money. Thankfully, it was virtual money, right? It was 1,000 virtual dollars in this trading game. Many went broke. Many completely lost the $1,000. Okay, and here's why. They had no plan with how they were going to do their bets. And since there was no entry rules, right, the particular game had nothing to do with the pattern that a stock chart makes. Okay, this game had nothing to do with, hey, I'm going to invest in XYZ company because it's better than ABC company. It had nothing to do with entry and exit rules. The only variable was position sizing. Okay, and 38 of 40, 95% of some very bright people lost money. Why? Because they didn't have any control of their position sizing. What we're going to do is we're going to take their winnable game and we're going to change it into a winning one. All right, it's a winnable game, but 95% of them lost. Okay, all right, so let's jump out of here and we're going to get over into the radioactive trading trade simulator tool. Now, here's what's great about the trade simulator tool. You can plug in your target return and your target loss. You can plug in your probability here, your starting amount, and however much you're going to trade. Okay, now these folks had even money. That means if they lose 100%, and if they win, they win 100%, and if they lose 100% of whatever it is that they bet. They had a 60% chance of winning, right? 60% chance of winning. And so here it is expressed as 40% probability of loss. Pardon me. And just for grins and giggles, this is the only thing that can be varied. What I'm going to do is I'm going to plug in 100%. Okay, and you know what's going to happen. You know what's going to happen. Eventually, even if you're lucky for a while, you're going to go bankrupt because you're going to bet and lose. Okay, here we saw one account that doubled, and then finally lost. Why? Because we're betting 100%, and even though we won 7 times in a row, 7 times in a row, and kept doubling our money, what's going to happen eventually if we bet at all? We're going to eventually lose. Okay, all right. Well, let's change this. Let's change this, and let's say that maybe some of those guys were a little bit sharp and they knew that they couldn't bet everything every time, so they just bet half. They just bet half, okay? And so now let's look at the simulation. What happens here? Oh, well, not good. We still went bankrupt. Anytime the balance falls below $250, we're starting with $10,000 in this example. Anytime the balance falls below $250, we're bankrupt. Okay, well, let's try it again. All right, this time it took 30 trades to go bankrupt. And let's try it again. Okay, this time it took 79 times to go bankrupt. All right, so obviously this is not a winning system. Let's try this one. Let's invest only 1%. We'll be very conservative. We'll invest only 1% of our capital. Well, looky there. That's actually pretty exciting. We're making some good money. Okay, if we're right more often than wrong, right? This is a very winnable game, isn't it? Okay, but let me take you to the sweet spot, because 50% is too much. We know 100% is too much, but 50% of our account is too much to bet. And 1% doesn't have very exciting returns. What if we made it exactly 20? The way that this particular game is set up, the way that this particular one is set up, 20 is the ideal amount to bet. All right, and the outcome is going to be different every time because of, this is just probability. It's not what's going to definitely happen. See, we had a 60% probability of winning, and this time only won, 58. That's fine. We still take $10,000 and triple it. Okay, this is the effect of doing what we call position sizing. The amount of the bet is what's important in this particular deal. Okay, so we took a winnable game that most people lost. Most people doing this did not use a system. They said that they just went by their feeling. They said, you know what, let me bet out of my 1,000, let me bet $100. And then they won, and they said, wow, I wish I had bet 200. So next time around, they bet $200, and then they lose the 200 and say, gosh, that hurts. Maybe I better be more conservative, and now I'll bet 50. And you see how this goes. They're just going all over the board, and that's why 95%, 38 out of 40, PhD has lost this game, a very winnable game. But you just saw where that same game could have had a more than triple performance, even if it didn't perform as well percent-wise as it was promised. Isn't that something? Okay? All right. Now, that's the first of the two things that I wanted to really concentrate on. Here's the second. We're going to introduce Skew. Now, the volatility signature of every stock, okay, is different. So, for example, GE is going to trade differently than Netflix, okay? Amazon and Facebook are going to be different than Wells Fargo, all right? They're going to have different types of volatilities. But with the radioactive trading system, okay, I'm going to show you the practicals here in a minute, but this is just an overview, all right? The radioactive trading system, what it does is it takes the volatility and adds skew. Okay, and what we do is, for example, if we are investing in a stock and we're going long, all right, we're bullish, let's say we're buying stock, and we expect that it could go up by 15 or it could go down by 15 based on how it's swung in the past, all right? What we're going to do is leave our upside open and increase our expectancy. Now, here's what just happened. We had 15%. By buying a put option, that's going to cost something. Let's say that it eats up, say, 5% of our profits. Oh, boy. Okay. So instead of making 15%, we only make 10, all right, if she goes up. But if she goes down, instead of losing 15, now we're making 5. Ooh, okay. That's kind of cool, right? Because what we've done is we've put a cap on how much we could possibly lose, but we've really left the upside open, and it could even go beyond 10, but it can't possibly go below a 5% loss. Okay, now here's a funky little equation. This equation is what pays for all the light, all the space, all the glitz, and all the glamour of Las Vegas. You ready for this? It's expectancy. Expectancy. And expectancy is calculated like this: probability of a win times your average win minus probability of a loss times your average loss. Now, if this number happens to be greater than 0, guess what? Over time, you're going to make money. And if this number happens to be less than 0, over time, even if in the near term you happen to make something, all right, over time, you will eventually lose. This is called expectancy. Okay, and the expectancy equation can be turned in your favor. What I'm going to suggest is that with your journal, you find out exactly what kind of ranges you can expect, what kinds of returns you can get when you're right, and what kinds of losses you'll take when you're wrong. And then there's only one thing that we can actually change. Guess what it is? It's this. It's how much your average loss could be. So in the example before, where I gave you this one, and we controlled this to precise amount of, say, only 5% maximum is what we could lose if we're wrong, right? That's what we're talking about here. We're talking about controlling the average loss. So it may not even, you may not even have to change anything else about your system. What you decide you want to trade, what kinds of stocks, okay? How you want to trade them, by going short or by going long, right? And what kinds of entry signals and exit signals you use. You don't have to change any of those things, but if you do change this one thing, how much of an average loss you take, it could completely turn your trading around. Let's take this to the Trade Simulator tool. Okay, what I'm going to do here is we'll look at our target return, and let's make it 15%, and our loss limit also 15%. Okay, and let's put everything we have into every trade and see how that works out for us. Okay, now our probability of a loss is let's make it 50-50. Okay, we'll make it 50-50. All right. So now what has happened? Well, we ended up being wrong more often than right. Because we're wrong more often than right, that's what most folks will blame. Because we're wrong more often than right, that's why we lost money. Well, let's try it again. It's random, so I can't predict what's going to happen. Okay, there's 50-50. Okay, oh, how about that? We started with $10,000, but we ended up with 3,205. Not cool. That's what 50% wins and 50% losses. Why? Well, because of the exponential and logarithmic nature of this. When you lose 15%, you don't need 15% to get back to even. You need something more like 18%. Okay? And so if you win and lose an equal number of times, and you're making 15 on the way up and losing 15 on the way down, guess what? You're going to cut into your account by 68%, right? Look at that. Okay. All right. So let's introduce skew. Remember our diagram. We'll go back to it here real quickly. Remember our diagram. We're going to take this to the Trade Simulator tool. And instead of shooting for a 15% return on a stock that has a 15% target, we're going to only take 10 because of the introduction of a put option. But whenever we're wrong, we're going to only lose 5. Okay? And let's change nothing about this. Oops, what just happened? Oh boy, it's Windows 10, guys. I don't know what to do here. Let's try again. All right, there we go. All right, so let's make our return more modest, and let's make our loss limit, pretty tightly controlled. You know what? Just for grins and giggles, I'm going to stack the odds against us a little bit. I'm going to say that we're wrong more often than right. But what happens? We still make money. Look at that. By controlling our downside jealously, by protecting it with a put option. A put option is a legal and binding contract that prevents you from losing more than whatever your strike price demands. Okay, and the way that we put these together, look at this. We have more losses than wins and still end up making money. Okay, more losses than wins, still end up making money. Kind of cool. Okay, so I'm going to pause right here and ask if there's any questions so far. Okay, are you guys digging this, first of all? You know what? Let me send out a little poll here. I'm just going to send out a little poll. And I'm just going to ask, think about what I just showed you. Okay, if every loss that you took last year was scaled down from whatever it was to 2 to 5% or less, first of all, could you stand to make a little less on your winners? Would it be okay? Secondly, do you recognize the fact that you'd have more capital to put into your winners if you kept your losses very low? What kind of effect would this have? T. Murphy says, makes sense, brings it home. Yeah, I want you to think about this, okay? If you were able, by using a legal and binding contract like a put option, to guarantee an exit to where you can't lose more than 2 to 5%, but if you're right, you make money, would it have been a better year last year? All right, so far, nobody's taken me up on that first answer, so everybody else is distributed among the last 3. Not everybody has voted, all right? We're about halfway through our class. It's, 12:29 here on the East Coast, 10:29 where I'm from. Okay, let me go ahead and close that poll, and we'll discuss this just briefly. Let's just discuss these results here, all right? We've got, first of all, nobody saying, 2 to 5 wouldn't have helped. Okay, we have 45% saying, you know what, I may have still lost last year, but I would have not lost as much. Well, that's good to know. Okay, let me tell you about 2008. One of my pupils in 2008 lost 0.6% of his capital, which means that he had 99 and 0.4% of it left. And then he's hitting the bottom of the market in March 2009. Kind of cool, right? Okay, 36% say I lost last year, but I would have won if I had done that. So that would have been a game changer. But look at these successful traders. 18% said, you know what, I did well last year, but I would have done better with this. Okay, let me hide this. We had a question come in or a comment. John says, but it costs money to limit to 5%, and many stocks will only gain 2 to 3 in a period, not 10% every time they're positive. Well, John, some of the stocks that I've been involved with over the last year have gained, 30 and 40 and 50%. You want to look at Netflix and Amazon and Google and Apple and some of these big winners. Green Mountain Coffee Roasters has done some pretty interesting things. Yeah. What I'm suggesting is that we confidently invest in stocks that have a bit more explosive upward power. And by the way, still addressing John, this same system that I'm suggesting can be applied in reverse. If you believe that the market is going to drop, they usually drop faster. Markets usually drop faster than they gain. So there's going to be a bigger move than 2 or 3%, isn't there? And if you're set up to profit from a drop, then there you go. Okay. All right. So let me go ahead and jump back into our class here. We'll talk about how this is done. Okay. Talk about how this is done. All right. Oh, you know what? We're going to steal the market maker's edge here in just a minute, but I misspoke. What we need to do is we need to jump over here into power options. Okay. So over here in power options, if you go to the married put tab, first thing that you'll see is my book. Okay, you'll see the blueprint. That's because the owners and employees of Power Options, you know what they trade? They trade my system. True story. They trade my system, even with 23 different strategies available to them. Oh gosh, what do they got? They got back spreads, and they've got condors and butterflies and collars and bull put spreads and bear call spreads and all kinds of things that they can do because their platform will find those trades and the best ones available, right? But you know what the guys in the office do? They do my technique. You know why? Because it works. And the fellow that I mentioned to you that had 0.6% loss in 2008, he's happens to be the director of education over there at Power Options. Okay, so anyhow, the search tool here will turn up a couple of good ones. It will turn up. It looks like today turns in 18 or so. I can't. I'm trying to do this where it's hang on. All right, there we go. I can scroll. Okay, good. Yeah, 20 results. Okay, and all of these stocks are really good. But you know what? I looked at this just before now, and I like Facebook. Okay, so what we're going to do is we're going to take a look at Facebook. Now, with Facebook, all I need to do is hit this profit and loss chart, and it'll populate this screen here. And now, with the screen populated, we know what would happen if we buy the stock plus a put option clear out to January of next year. All right, we've got an upward slope here if the stock gains, like Facebook has gained. Okay, if the stock gains, all right, then we have infinite upside potential. But if we lose, the most that we can lose is 8.1%. It's the most that we can lose. Now, here's something remarkable, right? The blue line is our value at expiration. The red line is halfway between today's date and expiration. So if we resign ourselves to exiting before expiration, we make more when we're right and lose less when we're wrong. Kind of cool, right? Okay, so instead of an 8% loss down here, it may be more like a 3% loss. Okay, that's the idea. All right, now what I want to do is I want to change this, and we'll do a put option that's only. Boy, oh boy, it's difficult to do this without the scrolling. There we go. Okay, we're going to pick one that's only 6 months away. Now, here's one reason why I like Facebook right now. Do you see that spread? The bid-ask spread is only 15 cents. Sometimes that bid-ask spread can be redonkulous, all right? But right now, it's only 15 cents. Okay, not 15%, but 15 cents. Okay, so let's see what happens with that. We're going to press submit, and we'll be filled at the ask, all right? And then this will give us another idea here. We've got 6.4% that we could lose, or $758. Again, getting out halfway, getting out in March, geez, we could only lose, a very small amount. Even if the stock goes down, we're losing less than the 6.4. So we're keeping our losses down in the 5% zone, like I talked about. Okay. On the other hand, well, how volatile is Facebook? Facebook has gained quite a bit since. Let's take a look at the chart. Facebook has done pretty well. Since the beginning of the year, it's gained over 25%. It's done pretty darn well. Okay, exciting, exciting. Now, where she is right now is in a base, and please don't misunderstand. I'm not endorsing Facebook. I'm not saying, hey, look, Facebook is a trade to make right now. I will say that we happen to be in Facebook right now. Power Financial Group happens to be in Facebook right now, and we're Bulletproof. We'll get to that later. I'll talk to you about bulletproofing later on. All right, but now, after showing you that, I'm going to show you this next segment. This next segment is the one I wanted to share with you that I thought you would really appreciate. And then the other segments we'll just blast through, okay? This segment is learn to steal the market maker's edge, okay? Now, that bid-ask spread that we just referred to, okay, is the advantage that every market maker has. For example, if I buy Facebook and then I sell Facebook immediately afterwards, I'm going to suffer on the bid-ask spread side. Okay, here's a fictional example. Perhaps the market maker is buying at 50.10, which is the bid, and he's selling at 50.35, which is the ask. And that 25 cents on a $50 instrument is about 0.5% every time he trades. And so he's going to want to trade all day long at that, right? I don't know about you, but it bothers me that the market maker gets an edge, that he gets to buy at the bid and sell at the ask. Would you like to reverse that situation? Would you like to have that kind of edge? You know what I'm going to do? I'm going to show you one way to do it. All right. We're going to use short-term trades to whittle away the cost basis. I'm going to show you the income methods. Now, there's 12 income methods that go along with the setup I earlier showed you. Okay, that married put. There's 12 income methods. For grins and giggles, I'm going to show you one today. Okay. So you own Facebook today at what price? Well, let's go in there and find out. Okay, what was it? Okay, Facebook is $128.28. Okay, so if we sold it immediately, it'd probably be $107.18. There's going to be a spread there. What about that put? Well, if we just bought it, we just bought it for 10.30. But let's look at the pricing again. Okay, if we were to turn around and sell that put right now, okay, we lose 15 cents on the put too. Okay, so it's not much, but it's something, and that edge is what makes Wall Street tick. All right, that edge is what puts them over the top again and again, because they trade it all day long. Now, here's what I'm going to suggest. Okay, I'm going to suggest that we're going to take away the market maker's edge, and we're going to do a near-term play. We're going to do a bear call spread. Okay, bear call spread. Now, let's open this up, and what I'm going to do is I'm going to get into power options and do a different screen. Okay, different screen. So here's my client log on, and I'm going to go to the custom spread tool, and I'm going to make a bear call spread, out of a near-term play. Okay, so here's Facebook. I'm going to view the options. We're going to make this a near-term play. Say, what's a month from today? Today's the 29th. Let's do a month from today. We'll do the weeklies here. Okay. Let's sell those 110s and buy the 115s. Okay, we're going to sell the 110s and buy the 115s. Now, watch what happens. Going to sell and buy. You know what I really like about Facebook? I'm going to show this to you again here real quick. I want to show you the pricing. Okay, the pricing. Because it's a nice liquid stock, look at this. There's an 11-cent bid-ask spread. Some things are like 25 cents, 50 cents. I've seen spreads as big as $1.40. It's ridiculous, okay? But this is just, here it's just 8 cents, right? Just 8 cents. Okay, so let's come down and let's find out what our bear call spread has done. Now, our bear call spread pays us, we get paid $140 to get into it, but there's a dark side. If the stock goes up, what happens? Well, we are going to end up owing more than we took out of it, all right? And so what's the risk? The risk is the difference. The difference is 110 and 115, right? We're obligating ourselves to deliver shares at 110. And we have the privilege of buying shares at 115, okay? So if we buy at 115 and sell at 110, then we lose $5. But that $5 is offset by the 140. Okay, so what's the risk of this? The risk is if Facebook goes up, the most that we can lose is $360. Okay? All right. Now, let's break out a calculator. I wonder if we can do that. Let me see. Calculator. Okay, all right, here we go. Okay, let's go back to this page here where we have the married put play. Okay? The married put play risks how much? 758. All right, 758. All right, and then we'll go over here to the custom spread builder. And how much does that risk? It risks 360. So what's the risk of doing both of these? I'm going to ask you guys for an answer. What do you think if I did both of these at the same time? If I did this bear call spread that expires a month from today, and I also entered into this married put, and that married put sticks around for 6 months. What's the risk over the next 30 days? What's the risk over the next 30 days? What do you think? 758 over here, right? And 360 over there. Okay? You got any folks with sharp pencils out there? Come on. I'm looking for my answers. John, I see your answer. Or I see your question. Actually, I already addressed that. Okay, good. So nobody wants to guess? Come on, guys. Here's what most folks would do. They would add the 360 risk to the 758, and they come up with over $1,000. But that's not how it works. It's not how it works. I'm going to show you how it really works, okay? Let's actually go over here and build the same spread. Now, remember, it's 758 risk, right? Okay. And what we're going to do, we're going to steal the market maker's edge. We're going to take on the obligation of selling at 110. That's what that selling that call is. But we're going to also purchase the privilege of buying at 115. And what happens? Well, if we sell and buy at those prices, we're going to generate $140. See, we see it over here in the, we generate $140 just doing the spread, right? Generate $140 there. So what's our risk? It had been 758. Now it's what? Now it's 639. What just happened? I'll tell you what happened. We just collected $140 from that bear call spread, and that bear call spread was done risklessly. Risklessly. Here's what I mean. Okay? The risk that comes from a bear call spread is that you don't own the stock, right? But if you do own the stock and you can deliver it, okay, and what's today's price? $107 and change. But if we can sell it 110, we're going to make a profit, right? Now watch what's happening. This thing coming down. This is the fact that the put option will come down in value as the stock's price goes up. But there is a way, I can't reveal it right now, but there's a way for us to manage this play and ride this red line. Okay? So if your stock goes up, great. If your stock stays flat, still great, right? Because you just collected $140 and you could do it again next week, right? Or next month. Here's another thing. If the stock goes right to 110, how's that? Well, great. You get 140 extra dollars plus you get the capital gain of the stock. All right? And we can do this more than once. You can do this again and again. That's what's kind of exciting. Okay, so what do you think about that? I'm just going to ask, what do you think of the income method that I just showed you? All right. Do you dig the idea of doing a spread trade risklessly? Do you like the idea of doing this versus, for example, a covered call? A covered call would not give you room to grow. But if your stock keeps going up, guess what? You have the privilege to buy at 115, and you've been paid for the privilege. You've been paid for the privilege. Would you like to know more about riskless spreads like this? I have 12. We got 12 different ways to play this radioactive profit machine. We call it the radioactive profit machine. Yeah. So I'm getting lots of responses. I appreciate it, guys. I'd also like to see a few questions. We got 47 of you here in the room and many more that are probably watching the recording. Please send me your questions. If you're watching the recording that we're recording this. If you're watching the recording, send your questions to support@radioactivetrading.com. Okay? All right. So let me go ahead and close this. 8% said that was wild. I didn't know you could do a riskless spread. Yeah. 15% said this one trade made it worth all the time I spent here today. 46, the biggest number, says I want to know more about riskless spreads like this. Oh, cool. You know what? Maybe I'll show you another one. 23% say, can I do what you just showed in an IRA or similar account? Yes, because guess what? You don't need margin to trade a bear call spread if you own the stock. If the stock is in your account, why then the rules for margin are relaxed. So you can do this within an IRA. All right. You can actually even do this with only a level 2 trading clearance. You don't need to have level 4 trading clearance to do a credit spread. How about that? If, guess what? You already own the stock. Okay. 38% say, I like that it reduced the risk. Can it actually go to 0? Well, yeah. Yeah, your risk can actually go to 0. Let's jump into here, and I'll go ahead and show you an example of one of our traders. Whoops. Am I signed in? I'm signed in. Yeah. Okay, we'll go to Fusion here. And the Fusion account is where you get to look over the shoulders of radioactive traders doing their thing. Okay, and so we've got Facebook here. Ernie Zerener, the founder of Power Options, happens to be in Facebook right now. This is with his own money. He happens to be what we call Bulletproof. Bulletproof means that he now has negative risk. See, Mike has also got a negative risk trade. What he's done is collected more premium than what the time value of the put option costs. Another way of putting it is that he's reduced the collective value of his stock plus his put option. He's reduced what he's spent for it, the cost basis, to less than what the put option strike price is. Okay? Let me show you what that looks like. Okay, what that looks like is this. Okay, let's say that that bear call spread expires worthless, right? That collected $1.40. Okay, let's say that expires worthless. So where's the $1.40 come from? Well, it comes from the cost basis of our stock here. So it would be what, $8.90 is how much how much it's like we paid. Instead of $10.30, it's like we paid $8.90 for that put the first time we do it and collect $140, right? And what happens? Well, we get the same hockey stick graph, but the water's a little shallower, right? And then what happens if we do it again? Okay, take another $1.40 off. Well, now we're down to $7.50, right? And so what happens? Here's what happens. That red water is getting even shallower, okay? And the risk is still lower, and the upside growth is still greater, okay? And what happens if we did that again? Okay, so far we've got just a few iterations, and there's 6 months to do this. And this isn't the sexiest income method. I just wanted to show you one that's pretty cool. Okay, what if we did another near-term one just right this second here, you know, and sold the 110 and used some of that premium to buy the 115. Okay, this looks more and more and more attractive as we go. As I mentioned, right now, see right here we still have 2% risk to the downside, right? If the stock fails and it goes down with a cost basis of over $107, if it goes down below 95, well, shoot, we could lose almost 2% now. We lose 2%. All right, that's the worst case scenario. Okay, but on the other hand, the best case scenario is that it could blow up to the good. You know, it could go up, and where Ernie happens to be, he happens to be in a place where it's negative risk now, negative risk. So, for example, his cost basis is really low. From doing what? From doing income methods. Okay? So here's negative 0.8%. What that means is, it doesn't mean you're going to make negative 0.8%. It means that if the worst possible thing happens, you're going to make 0.8%, but you're probably making more, right? That's the idea. All right? We want to control our losses. So where Ernie is right now with Facebook is negative risk. Okay? Where Mike is with Boyd Gaming, negative risk. Okay? That's the idea. All right, so let's take some questions. Some started buzzing through. All right, let's go ahead and take a look. Gene says, what is the maximum percentage you would pay for a one-year married put? Gene, what I want to do is keep the risk down to single-digit percents, okay? And the guidelines and everything are made really clear in the blueprint of how to do that. But you know, the maximum percentage, what I want to do is I want to have the sum of the stock plus the put option. I want to be able to get 92% or more of it back. Okay, so I'm only gambling, say, 8%, and I'm not going to hold it for a whole year. I'm not going to hold it for a whole year. And we're going to make adjustments too. Okay, all right. So that's kind of wild, all right? The risk of the married put plus the risk of the bear call spread equals, no kidding, it equals less risk in both. That was the point of that one. Now, income method number 11, I'm not going to spill that tonight, okay? We're going to look at income method number 11 tomorrow night at the actual webinar, okay? So, all right. Okay, those two that I just showed you, those two were the real big ones. They were the real big ones for tomorrow's, what do you call, for tomorrow's class on how to make 2016 your best year trading ever. Okay, I'm going to take a couple more questions, and we'll just go ahead and wind her up. I do want to let y'all know about the end of year special. Okay. Sachin says, this is good stuff, but does it work for small accounts? Buying stock would need a big account, right? Well, it depends on what you mean by a small account, Sachin. I got hurt really badly in the late 90s trading covered calls, and I think maybe some of y'all have felt that sting too. Okay, I was taught, hey, you know, get volatile stocks. You know, they have better premium. I was taught, hey, trade on margin. It doubles your return. I was taught a lot of things that ended up being really bad things to do. And after researching how fund traders do things, I came up with the radioactive trading system, and I began my account with $2,500. So if your account is greater than $2,500, you could probably do all right. $2,500 is what I started with in, October of 2002. And back then I only had 4 income methods. Okay. Eli says, what happens if Facebook runs to 117? Oh, you're welcome, Sachin. Eli says, what happens if Facebook runs to 117? Oh, great stuff happens. Okay. Let's say she goes to 117. Okay. So, so the stock has gone above 115. So what has happened is our stock goes up, Here we have to deliver it or manage. There's management techniques in the blueprint. I'm not going to get into detail, but let's just say we don't manage. All right. Okay, so we don't manage. And our put is beginning to lose value as the stock is continuing to climb. The put option is beginning to lose value, but because of the way we structured this, we're still getting out at a profit. Now, at 117, guess what happens? We've been paid to own this long call. Okay, recall this. Back up here, we took on a premium and then spent some of it on the long call. So it's like we've been paid to own this call. We've been paid $1.40 to own this call. We've gotten out of our stock with a profit. Our put has begun to decay a bit, but now we have the privilege to buy at 115. And in fact, that'll happen in the middle of the night, whether you ask for it to or not, at expiration. All right, that's going to happen. If the stock goes to 117, guess what? You've got a stock that you purchase at 115 that is now worth 117. And your put option is already paid for and still in your account, so it's protecting you. At this point, if the stock ever declines, it declines to this profit point. But if it continues to extend, it extends, into infinity. This is, not infinity, but it's infinite potential. With Priceline, for example, I did this play. This was the bottom of the play, and Priceline continued 40% after. Okay. Now we don't say that, hey, you get 40% returns every month. That's ridiculous. But we position ourselves for 40% returns every time we enter one of these kinds of things. And if it happens, great. And if it doesn't happen, still great. We're not going to get hurt. Okay? Many of you told me that it would have been a different year last year if you just kept your losses down to 2 to 5% of your overall capital. And guess what? That's not just possible, it's enforceable. This is a legal and binding contract that you're buying. When you buy the put option, it's not a stop order that can get violated. It's a binding contract. Okay. All right. Cool. All right. I'm going to take maybe just a couple more questions, and we'll finish this up. How does this system work for a bear market? Sachin, that's covered in the blueprint, but I'll give you a hint. Okay. If you wanted to do a short position with a stock and buy a call, that's one way to do it. But we actually do a synthetic kind of a derivative instead. And it involves setting aside some capital into an interest-bearing account and also buying a put option. And you're going to want a higher trading clearance than normal to do the income methods. You can do the income methods. Okay, you can still do most of the 12 income methods on a bear PM. We called it an RPM, radioactive profit machine. When you buy stock and the put option that's in the money, and it's all according to the right parameters, we call that a radioactive profit machine, or RPM. We call it a bear PM. And the bear PM, the secrets of the bear PM are in the blueprint owners area. We've got a recording up. It's about an hour and a half, and give you all the secrets. Okay. This is interesting, says John. How do we sign up for tomorrow night's webinar? John, tomorrow night's webinar is open only to owners of the blueprint. So you would want to go to radioactivetrading.com/EOY. So I'll go ahead and put that up there. radioactivetrading.com/EOY. End of year. And when you go there, what you'll get, you're welcome, what you'll get is this recording explaining all the bonuses that are happening with the end of year promotion. Okay, I'm going to send that to everyone. I'm going to send it to you in the chat box. It's www.radioactivetrading.com/EOY. If you're watching the recording, this is not a clickable link. But for those of you that are on the live call right now, that is a clickable link that I just sent you. And it'll bring you to this page, which will explain all 8 bonuses that Power Financial Group is giving away along with the purchase of the blueprint. Okay, so it's kind of cool. The bonuses add up to more than what the blueprint costs. Uh, Also, a question that comes up very often is what's the difference between the blueprint and the home study kit? The blueprint is the book that contains the entry for both the RPM and the Bear PM. It contains management techniques, and then it also contains the 12 income methods. Now, the Radioactive Trading Home Study Kit is the blueprint plus 6 audio-visual CD presentations that break everything down in animated examples. Okay, so if you learn better that way, it's a better investment. But in truth, if you're being thrifty, if you're being frugal here at the end of the year, the best thing to do would be just to get the blueprint. The blueprint has all 12 income methods. So you're spending $339 for that, or you're spending $600 for the home study kit. Here's a couple of testimonials. Wolfgang said, "You guys are great. I am new to the RPM, but I'm not new to options trading. I've read tons of books about options, Macmillan, Elder, Carter, and many others, but none of them put all this together in a context that really makes sense and preserves my capital. You guys did. You give options trading a completely new touch. Amazing. Thanks for that." Here's Chris. Chris said, "You have a great service. Since I started using your strategies, I've made over $61,000 in 3 months. I really enjoy your service and product." Matt says, "First off, love the material and the service. I just tore through the blueprint this weekend. I previously worked on a derivatives trading desk, and your strategy is very unique. I plan on using a married put strategy combined with dividend stock investing to allow the dividends to help finance the protection. Then wait for movement, adjust, bulletproof, profit." And there's many more testimonials here on that deal. But I'm going to recommend that you go to radioactivetrain.com and pick up the end of year offers along with the blueprint. Something that's impressive, okay, about Power Financial Group, they are now the publishers of the blueprint. And what's impressive about them, besides the fact that they listen to their customers and continually improve the power options trading platform, something that's more impressive to me is this: they stand behind everything that they've produced, including my product, the blueprint, with a 100% money back guarantee. Okay, so can you imagine? You're thinking, well, geez, maybe this setup is going to work out for me. Maybe learning how to take income while I'm sitting on a stock, but not limiting my upside, like a covered call play. Maybe this is what I want to try out. Maybe I'd like to know 12 different ways to milk a stock for income rather than just, one. Maybe I'd like to protect myself in case of a downturn. But maybe that bulletproofing thing would work out. Well, guess what? This offer is bulletproof. All right? If you're not happy with the blueprint for any reason, go ahead and send her back. It can take about 30 days. You know what? It doesn't have to be 30 exactly. If you take 35 days, they'll still accept it back. All right? But 30 days to check it out. And most folks report that they were able to pay for their blueprint with their winnings. All right, so folks, I'm going to go ahead and wind her up. It's 11:02 in my neck of the woods. Whoop, just turned to 11:03. It's 1:03 on the East Coast. I'm going to look for the questions, see if there's any more questions. So there's no discount. Now, Randy asks, is there no discount for the end of year offer? No, we never do discounts, never ever. Okay, so don't be waiting for that. We don't do discounts, and here's why. First of all, it just seems cheap, to roll up your sleeve and say, "Hey, senor, you want to buy a watch? And it's $10." And they say, "Well, how about 5? Well, sure. How about 2? And no, we charge what we need to in order to support the product. We charge what we need to in order to support the product, and so there's never any discount. What there is here at the end of year offer is added value. All right, the gang over at Power Options is adding just amazing bonuses. You'll have to go check them out, okay? But amazing bonuses there at radioactivetrain.com/EOY, okay? Is this webinar session for me to recorded for me to review later? Yes, it is, Chris. we're going to record, or we have recorded this, and we're going to be posting it later today. Other questions? I think there's something I'm supposed to make sure that you know before I let you go. I'm not remembering what it is. All right, folks, I'm going to go ahead and wind it up then. It's 5 past the hour, oh shoot, let's go ahead and take a look here. Maybe at the very end. Okay, yeah, we're done. Folks, we'll see you out there. I'm going to recommend again that you head over to radioactivetrading.com/EOY. And here it is again, in order to see all the bonuses. And, just check it out. Just listen, And if you haven't decided to pick up the blueprint, maybe this will get you off the fence. It's a money-back guarantee. It's the last thing that we're doing this year, and there's never been a better timing with the 8 bonuses. Okay? All right, very good. Folks, we'll see you out there. This is Kurt signing off. Happy trading, and bye for now. Bye, Chris. Thank you. Chris wished me a happy new year. All right, see y'all out there. Happy trading.